Welcome to a special Indianomics. The July inflation number at 7.44% was uncomfortably ugly, even for a market expecting a high number. So let me start by drawing up the positives and the negatives from the numbers. First negative, of course, July CPI came in at 7.44%, an ugly number, versus the poll of 6.66 and the June reading of 4.8%. Now, the positive, the July CPI, as you can see, is 2.6 percentage points or 260 basis points higher than June. But of this 260, about 230 basis points or 2.3 percentage points was contributed by vegetables. Next, negative again, not just vegetables, but cereals were also up. 13% higher for cereals. Pulse is also up 13%. So it is a broad-based food inflation, not just vegetables. But then the counter positive, core inflation, that is CPI, excluding the volatile food and fuel elements, was down to 4.9% from 5%, which was our poll, and 5.1%, which was the June reading. Actually, the Jan reading was 6, so it's substantially lower. Net, should we worry about rate hikes or about rates remaining higher for longer than we thought? Will the Reserve Bank keep liquidity tighter than we thought? Will the newly introduced incremental CRR, cash reserve ratio, continue for longer than September? Is there an incremental impact on yields and hence on growth in the coming quarters? To answer these questions, I have with me an elite panel, Mridul Saggar, a former Reserve Bank of India MPC member, now professor at IIM Kozhikode, Neeraj, Gambhir, the head of Treasury and Global Markets at Axis Bank, Upasana, Bharadwaj, chief economist at Kotak Bank, and Sakshi, Gupta, the economist at HDFC Bank. Okay, the banks are clearly well represented. Ladies and gentlemen, thank you very much indeed for joining me. Mridul, we have to begin with you because you know how to think like the MPC members think. See, will they just look through because it is all vegetable? Cereals, we are told, can be pretty sticky. So is this a little more worrying than just a transient number, the food inflation?
Definitely, we are likely to be more worried, not just we outside the RBI, but even RBI probably would be more worried. In essence, this is a food spike which is larger than what anybody has anticipated. And the issue is, would it last or not? See, ideally, it's true that the MPC would look through any transitory inflation, and it's a right thing to do, as they did in the last policy here in August. But a couple of things really worry me now. And one is clearly that, any statistics which is not deterministic has outliers. So this time what I am seeing is, there are outliers and outliers when you look at IMD maps. So if you are looking at the heat map which IMD gives, then clearly it's loaded with yellows, which means largely deficient, more than 60% deficient, or it's the cobalt blue, which means large excess. And week by week, we have seen this pattern really disturbing. So it is possible that this food inflation may last a wee bit longer than ordinarily what we were expecting, that September correction would come. Now, it's anybody's guess what the policymakers might do. I think they would wait and watch for at least till the September data, but the September data would come after the October policy.
Yep.
So a lead call would have to be taken by looking at the data before that and take a decision in October what they need to do. I mean, liquidity, as you mentioned, is an easy way out. So you should keep things tight by mopping up all surplus liquidity. And I'm glad that the incremental CRR was raised to do that. There are other tools, so it's not necessary that you need to sort of hike CRR or incremental CRR retain for longer. But yes, the policy rates would stay where they are for longer, for sure, if not on the up.
Okay. Let me come to Neeraj a little later. Let the economists have their say. Upasana, Your thoughts on whether this is a little more than just a tomato vegetable inflation? See, on cereals, I did have Dr. Gulati and Harish Damodar and such other agricultural economists. The fear is that the rice crop, the procured rice, some of it was broken rice and not really of edible quality. And the forthcoming rice crop, although the sown area is higher, some parts excess and some parts deficient, as Mridul beautifully explained. So, and wheat, you know, if El Nino hits now in July or starting from August, then wheat could also be deficient. So are we building up for something worse than just a transient inflation?
Yeah, Latha, I mean, firstly, you know, all of this is based on a little bit of speculation because we really don't know how the weather conditions will pan out. And hence, at the moment, to take a final call on how things will pan out in the subsequent 2 months is going to be very difficult. Having said that, yes, it is not just vegetables, while they have been the biggest contributor to the 7.44%, but it is cereals, pulses, and spices, not to forget that.
Yes.
I mean, all these three categories have been contributing consistently to headline inflation. And that is something which we'll have to be extremely careful about because pulses, cereals, they tend to have a much more structural impact on inflation, while vegetables we know, will correct. If not in 1 month, they will correct in a couple of months ahead.
Yep.
But we will have to be much more closely watching how the cereals and pulses will be panning out, and plus spices, like I said, because spices too has been consistently on a month-on-month basis, if we see, have been moving significantly higher, and we're not seeing any signs of abating there as well. So all these three other categories are also to be very closely watched out for. But again, just to note one thing, last year, during the September period is when we started seeing the Kharif sowing pick up significantly. So, we still can see any side of this, we can see things pan out in whichever way from here on.
Okay.
So we'll have to wait and watch. Clearly, there is a very significant risk. But I think a wait and watch policy is what even the MPC and RBI would also go ahead, at least for the next 2 months.
Yeah, 2 months. It's actually, I'm worried about beyond that. Spices, yeah, by the way, as Upasana was pointing out, 21.6% higher year on year. And as she's been pointing out, month on month, it's been rising. It's just that the weight is 3% or 3.5%. So I ignored it. Cereals, obviously, 12%. So weightier. A final word from you, Sakshi. What are the dangers of inflation getting generalized? Or is it not a danger at all, given what crude core is?
So, Latha, I think I'll side with, at least given what we are seeing, is happening on the food side, and not just in India, but I think we also need to keep an eye on, global food inflation, because El Nino is not a localized phenomena which is just centered in India. I think it is having an impact on a lot of the other Asian economies, as well as, some of the developed markets, both Latin America and the US. So I think given this perspective, I would be a little bit more cautious in projecting where inflation is headed from here on. I think we might be, Upasana rightly said that there are uncertainties related to how weather conditions are going to pan out. But I think we might be underestimating this inflation increase purely because of the fact that if you do see, we know that food inflation, certain parts of it tend to be temporary or transitory in nature. But that being said, if you continue to see inflation printing, headline inflation printing above 6% for the next, 3 to 4 months, I think it will start feeding into core inflation as well. And I think that's something that we also need to kind of think about and worry about.
Oh, yes, of course. The only thing I checked is that edible oils inflation has not risen. We did see a little bit of spike about 3-4 months back in Indonesia in palm oil and sunflower, but that's at least playing to our advantage. But Neeraj, now for the market reaction. Is it just likely to be knee-jerk, or will there be a persistent worry, as Mridul says, that the RBI will tighten?
I think for now, the market will, it's basically a slightly difficult call in the sense that we were all expecting the inflation to go up for this month and the next month But the size of increase is actually what has surprised everyone. Now, we still don't know what the full story of this is in the sense what the next 2 months will do. But clearly, from a bond market perspective, we'll be on the watch out. It is not going to be easy now to talk about a rate cut anytime soon, unless and until we see inflation numbers come back into the trajectory that Reserve Bank has talked about. And mind you, even in that trajectory, we were not seeing 4%. We were still close to 5%, right? So unless and until there is a real, movement towards that trajectory back in the next 2-3 months, I think the market will continue to be worried about where this is going and whether there is a possibility of further tightness of the liquidity or maybe a rate hike at some point in time if things don't settle down well. Okay. So yes, the market will be concerned about that.
Like Mridul said, repeatedly the governor also said that we have instruments other than rate hikes. So, what are the chances, Neeraj, first of all, of this incremental CRR getting into, pushing up lending rates? And more importantly, if it continues on September 8th after the expected review, then does it make it incumbent that lending rates will rise?
So it's possible that this liquidity tightness, okay, before I say that, what happens on September 8th is not just dependent upon what happens to inflation or what has happened to inflation, also how the liquidity plays out between now and September 8th. So if the liquidity continues to be in a surplus of, say, 2 to 3 lakh crores that it is right now, then the possibility of this incremental CRR hike getting extended beyond September 8th, to my mind, rises considerably. But if the market liquidity comes back into, say, about 1 to 1.5 lakh crore number, then I think there is no reason for RBI to continue with this incremental CRR hike. Inflation worries, coupled with the fact that we will likely to see Reserve Bank siding in the direction of trying to keep liquidity balanced, if not very tight, I think will lead to some short-term reaction in the market. We have seen short-term CD rates and short-term, probably swap rates, etc., go up. Whether that translates into the lending rates as yet, I think there is some time to that. I would think that another 2 to 3 months of this could potentially lead to that outcome.
Okay. Mridul, what is I'll come back to the liquidity and incremental CRR in just a minute, but what are your estimates about whether it could get generalized at all? Or is this just an outlandish question at this point in time?
No, it's not outlandish. It's very much something to consider about. But unfortunately, we do not have information whether or not it will get generalized. The problem with the food supply shocks have been, we have seen that in the past. Sometimes they come too frequently and they get generalized. As of now, we don't have the data to show any generalization is occurring. So there's a comfort on that front. But if, for instance, these prices feed into inflation expectations, and that's what most, where the policymakers often tend to go wrong worldwide, is that they sort of underestimate the effect food inflation can have on overall inflation and discount it more than what it needs to be. So that is something we need to guard against. But at the same time, this is not something of a given that you take an action straight away. And the whole point is about living with uncertainty, and the maturity is all about whether you can live with the uncertainty and take the right decisions, internalizing what uncertainty is. And for that matter, this policy did do that. It didn't go overboard. It tried to keep liquidity down. So it was doing the right sort of fine-tuning.
Okay, actually that's well pointed out that food inflation's impact on generalized inflation is important to worry about. I still remember the episode from 2009 to 2013 thereabouts. We called it protein inflation forever, as if the whole world can have a sudden epidemic of eating proteins, when it really turned out to be generalized. So I guess that lesson is learned all over the world. But we have to take a quick break. I have lots more questions on whether we should even debate, or whether the MPC will debate a rate hike. That question after the break. Welcome back. I've been discussing the shocking July CPI number of 7.44 with 4 experts. I have been speaking with Mridul Saggar, with Neeraj, Gambhir, Upasana, Bharadwaj and Sakshi, Gupta. Ladies and gentlemen, thank you very much for waiting on. Mridul, actually that question to you. Do you think the MPC will have to debate a rate hike, even if they don't go ahead with it?
Isn't it a no-brainer, Latha? I mean,
Rate hike,
MPC
really?
ought to, no, but at least all options they have to consider, and the rate hike would definitely
No,
come
what I
into,
mean is, if you were in the MPC today, like you were, 18 months back, would you seriously consider debate, not just as an option, but that it is incumbent now 7.44 and, the full year inflation may be 5.6 or 5.8. So is that even an option they will debate?
Latha, 2 things. One, I would say to answer this question, I don't have to wait till 24th August when the minutes will be out, but I'll have to rather wait for basically the September inflation numbers, the lead numbers, even if the consumer data has not been very accurate. I mean, one need to see where the food inflation is going. And if there is by then some further shocks on the way, then obviously this will be on the table. Not that they would actually necessarily do that. I mean, you have to sort of consider all factors.
Okay.
But when you are debating in MPC, you tend to debate everything which is possible and what its implications would be. So that would be a fair point to say that there will be some consideration. I'm not saying we need to sort of say now that, the rate hike is coming.
Okay.
By no means that's the case.
Okay. Okay, fair enough. Then let's use the limited time to check about other possibilities. Neeraj, would it not be a little difficult to digest if the ICRR continued after September 8th? After all, it is for that limited period liquidity, May 19th to July 28th. To continue that ICRR beyond September, is the definitional problem, you think, that therefore they will discard that tool and go to other tools?
I would think that if there is a need to continue with something like an ICRR or an instrument to take out liquidity from the system, which is required for longer than September 8th, then I would think that there is a need to use other tools than just ICRR. Remember, ICRR has been positioned as a temporary hike, right? And the way ICRR is computed is on incremental, deposits of the banking system. Now, the distribution of that incremental deposits in the banking system is not necessarily the same as the distribution of existing deposits in the banking system. It's uneven in that sense. So I think, given the construct, I would expect that if there is a need to continue with tighter liquidity regime or some action to tighten up the liquidity further, I think it would have to be something different than ICR.
Okay. Upasana, let me come to the inflation part and the fiscal response. It is an election year. And if you continue to have this kind of pulses prices or even cereals prices, which some believe can be high even in the Rabi months, especially if the reservoir levels are not as good, then do you think that we're going to see receding of capex and more of revenue expenditure because of income transfer programs, and that will be automatically inflationary? Is that even a factor?
Latha, at this moment, I think we should not rule out anything. Because of the uncertainties which we all have been discussing at the moment, right? We don't know how things are going to pan out. But we need to keep in mind that we have seen a reasonable amount of favorable marketing margins with the OMCs because of the lower crude oil prices earlier. And at this point, I think that is one big tool that the government would have to offset the rising food prices with the lower fuel prices. We haven't seen the change in pump prices at all for quite some time. So I think that is one clear tool, which can probably not even result in fiscal slippage because, they can just ask us OMCs to take that hit.
Roll it over, yes. But more income transfers, which can hit the fisc, is something you won't rule out.
Yes, we can't rule that out as well. It will depend on the scale of the problem that we are talking about.
Okay. All right. Sakshi, what about growth? If there is a possibility of this continued, high inflation, that takes away from consumption of several items because your money is deployed elsewhere for the consumer. And if capex also were to take a bit of a backseat, is all this leading to you to a chance of growth getting trimmed?
Yeah, I mean, Latha, on the growth side so far this year, I think we've been positively surprised if you look at sum of all indicators, right? So, if I factor in, high inflation, food inflation for the coming months, disruptions to rural demand because of monsoon-related, issues, there, and of course, what's happening globally, because, I think in the fourth quarter of this calendar year, you will start seeing credit conditions tightening further and growth coming down in economies like the US as well as Eurozone. So there are, downside risks now to the second half growth estimates that we have. I think just to, apart from all the other indicators that we look at, if you start looking at, for instance, the job market, to me, that is turning out to be a little concerning as we move forward, because if you look at the Manrega demand, for jobs, that's been going up. If you look at, the urban sector, hiring intentions now seem to be slowing down in non-IT sectors as well. So clearly the consumption story, both from, an income perspective, inflation, rural demand, seems to be, kind of flagging a risk that perhaps we are moving into a, time period where there will be a slowdown, which hasn't happened so far.
Okay, yeah, and that may perhaps be the antidote to inflation also. Mridul, last thoughts from you. What's your sense about the rate cut, therefore? Gets pushed to August, or, whatever, nowhere in the horizon at the moment?
Nowhere at the horizon in moment. Into the next year, it could be possible because global growth will start slowing down from now. That slowdown has been postponed, I thought. But what we are seeing now happening in China, for instance, there too, the weather disruptions have really caused a havoc. The northeastern provinces, which account for 20% of the crop there, grain crop, has been all destroyed. So we have a tough year here, and China's slowdown is very palpable with property sector prices. Tightening is not over. Fed, the CPI inflation again has nudged up. There have been increases in inflation in Brazil, in Russia. So we don't know where the global monetary policy cycle is heading for. And we need to be cautious in this uncertainty, as Upasana has also been stressing. So we have to wait and watch and not really be in a knee-jerk reaction of cutting or raising the rates. I think with the global slowdown, the raising rates may become more difficult, but cutting also looks difficult if inflation remains unanchored, especially if you believe the target is 4%.
Oh yes, we should remember that. Well spoken as an MPC member. Neeraj, finally, what's the range for the 10-year? And recently we heard from experts from the US who believe that, we have to get used to at least a 4% on the US 10-year, given that guesses on yields in India.
Yeah, I think this 4% on 10-year has come after a long time in US. For the best part of the rate hiking cycle, the US yields were below 4% and somewhere close to 375. So that's the worrisome part, that at this late stage in the cycle, the US long bond yields are rising, and that is obviously a cause for concern. Domestically, I think we are still kind of in a very range-bound zone, as we spoke a couple of days ago. I will still expect at around 725, 730 is the peak for now, unless and until we feel that the rate hike is becoming an imminent possibility. That is not the case at this point in time. So I think market is still kind of pricing in for a fairly stable, maybe higher for longer kind of a rate regime, but no rate hike priced in as yet.
So 7.7 quarter to 7.4 thereabouts?
Yeah, 7 quarter, 735, and I think on the downside at about 715. So I think it's a very range bound market. to my mind.
Fair
at this
point. And so has the rupee been. So that's the saving grace, of course, as far as the rate market, the debt market is concerned. Thank you very much, Upasana, Sakshi, Neeraj and Mridul for joining in and giving us the benefit of your opinion. Well, the point is that one should not be talking about rate hikes just yet or even generalized inflation. But nevertheless, the worry is that perfect Goldilocks scenario of falling inflation and rising growth has clearly ended. Now it's a question of inflation getting worse than expected and growth possibly a little lower than we thought. On that slightly cautious note, we wrap up on this edition of Indonomics. Thank you for watching.